Okay. Spring break, you're probably back at school now. It's Sunday afternoon for me, 2:45. And I'm doing a video here for problems 1 and 3 because the folks on the exam and because you have the chance for extra credit this coming Thursday morning at 7:30. So what I thought I would do is give you, I'm going to go over this in class, but I thought I'd leave it as a study tool, create a little video. So I've already laid this all out. Now I'm going to go through it quickly, but you'll be able to slow it down. Let's say. So I've laid out the facts here, and I'm going to go through them and highlight the key concepts. But this is problem 1. So they laid out some of the facts. I laid out these facts. These all come from the problem. A company acquired, the parent company acquired Ramp for $700,000, 40% of Ramp. This is equity method. Ramp had a net book value of $1,500,000. So that gets you 40% of that is $600,000. So you paid for $700,000 for 40% of net book value of $1,500,000. That's $600,000. So you had an excess. They said $72,000 of that was when they said in total the book value, the fair value of the buildings were $180,000 more than the book value. And so 40% of that, because you get 40% of that excess, 40% of the 180 is 72, and then they don't tell you anything else. So the other 28 has to be goodwill. Okay, and that's important because we have to amortize when there's an excess. We have to amortize it because the net book value Ramp will do their own depreciation, but in consolidation, we're recording it at fair value. And so we have to record the depreciation on the excess of fair value of a book. It said in 2020, Ramp had income of $300,000, and 2021 they had $120,000 loss. They told you what the dividends were in 2020 and 2021. And then they gave you some information about intercompany sales. They said the sales value from the sales value from Ramp to Pond, which is the parent. Well, the cost was $60,000. They sold it for $96,000 of the amount, and then of that amount, it said $72,000 was resold. Okay, so then we're trying to figure out what's still not resold to an end customer. So we now have $24,000 is unsold, at least at the sales value. We have to, in the equity method, we have to eliminate the profits, right? Not the revenue and the profits, just the profits. So we find that the profit in that was, they give you this, it was 36. I think they gave you the inventory in total had a cost of $60,000 that we sold for $96,000. That leaves a $36,000 profit. So 36,000 divided by 96 is 37.5%. And that's the profit in that unsold inventory at 24%. That's $9,000. 24 times 37.5, $9,000. But remember, we only own 40% of it. So we only defer these inventory numbers with total value, but we only defer our share of it. So that's 40% of it, or $3,600. Okay, I'll go through that one more time. So the concept is on an equity method investment, when you upstream, you sell to the parent, or downstream, if it's not resold to end customers, you can't recognize the profit unless it's resold. But you don't defer 100% of the profit in equity method. You defer the percentage that you own. Okay, if it was controlled, like in consolidation, we have 150% ownership and control, you defer 100% of it. But here, because Pond owns Ramp 40% of it, we're only going to defer 40% of it. Then we have to figure out how much to defer. And what you need for that is, well, how much was sold, 96 at sales price anyways. How much was resold, 72. So that there's the amount at sales price that hasn't been sold through is 24,000. Then you say, well, what's the profit in that? And the way you figure that out is 96 minus 60, and so that's at a profit 36. That's a gross profit of 36. When you take 36 divided by 96, it's 37.5%. So that's the profit that's in that 24,000. So 24,000 times 37.5 is 9,000. So that's the total profit in the unsold inventory, but we only have to defer 40% of it because we only 40% of ramp, and that consists of 3,600. Okay. So let's go. So that's all we need for the 2020 piece. So we'll go over here to 2020. So ramp had $300,000 in income. We take 40% of the 300,000. That's 120. They gave us dividend numbers, but dividends they don't impact income, so I'm just going to ignore that. We had excess depreciation here. The 72,000 divided by a 12-year useful life. That's 6,000 a year. That's an expense. It's a reduction in income. And then we had the intercompany deferral over here, the 3,600. That's another reduction. So when you all add all that up, those are your pieces, and it gets you to 110,400. Okay. Now we go to 21. We'll start over here on the income summary. They had a loss of 120,000. 40% of that is $48,000 loss. Dividends, we ignore those because they don't impact income. Excess depreciation, that didn't change. So if we had in 2021 for 6,000, we had in 2020 at 6,000, we have it at 2021 at 6,000. The amount of deferral that we had in 2020, it's said that those items were sold through in 2021. So we'll reverse that. We'll make it a plus 3,600. And then we have our own deferral at the end of 2021 for 9,600. I'll walk you through that. It's the same as 2020. So that all adds up to 60,000. Okay. So let's do it for 2021 here. They said, okay, the cost of what I sold 180,000 sales value with a cost of 108. Of the 180 that I sold, 120 was resold, so 60,000 is unsold, and that's sort of the basis for what we're gonna have to do our deferral on. I figure out the profit in that 60,000 because that's the sales value. Figure out what the profit in that is, and I determine that 180 minus 108, that's your gross profit. 72,000 divided by 180, that's a 40% profit. So in the 60,000 of unsold inventory, there's 40% profit, or $24,000. But then I only have to defer 40% of that, my ownership interest, and that's $9,600. Okay, that's the 96, and that goes over here, the $9,600. And I'm moving quickly through this because you'll be able to watch it a couple times and slow it down and rewind it. Okay. So that is problem 1. And you're going to get something very similar to this on Thursday for those that opt for the extra credit. Okay. I'm not doing, a lot of people got problem 2 right, so I'm not going to do that. And then we'll go to problem 3 now, chapter 3. All right. So this is on consolidation. And I think they're asking for income for 2021. Well, first of all, they gave us the amount, the consideration that we given was that we had 11,000 shares. I think it's a $1 pop value, but that doesn't really matter. In this problem, they gave you a lot of extra information that you don't need. You have to sort of sort through what you need and what you don't need, just like the real world, by the way. But they said they issued 11,000 shares at a fair value of 17,000 shares, so the total consideration was 187,000. The book value of what was acquired was 120,000. That left an excess of 67,000. And they said 6,000 of that was equipment. They gave you that, and they said the rest of the excess was related to a patent, 61,000. Okay, so there's no goodwill. So 6,000, it's told you had a 5-year life, so that's gonna be $1,200 of excess depreciation. And the patent had a 10-year life, so that'll be 6,100 of amortization, okay? They give you a lot of information for 2020, but they're only looking for the income for 2021, so I left that out. And here's all the income the info they gave you for 2021. I guess I gave you, right? So I had revenues and expenses, investment income with no information, dividends, equipment, retained earnings. Now the only items that impact income here, at least from this table, are revenues and expenses, right? So James, we go to the income summary. James had, we're consolidating, 100%. They had net income of 840 minus 552, or 288. Aaron had net income of 156, which is the 336 minus the 180. There's no information on investment income, so there's nothing you can do with that. You just leave it out. Dividends don't impact net income. Equipment does. They're probably trying to give you some information, maybe to trick you into doing some depreciation, but it's assumed that Aaron's depreciation is already included in their number. What we have to do is provide for the excess depreciation, which we will. And then retained earnings doesn't itself have anything to do with net income. So there's some extra information they're trying to just confuse you, or I'm trying to confuse you. So anyways, you had those two pieces, and the other, so you had the net income for James and Aaron. All you have to worry about is the excess pieces, the excess depreciation, which we calculated up here at 1,200. That's a reduction, and the excess patent amortization of 6,100. And so it's the sum of those four items that gets you to the answer of 436,700. Let's say, and I don't know how long this has been going on, but I wanted to do it quick. And if you could follow quick, that's great. If you have to go back, maybe you can cover this with Kate. I'll alert Kate, the tutor, if you guys need some help on, I think it's Tuesday night. Anyways, I'll see you in class tomorrow, probably before you see this video. Let's hope for that we get in the tournament tonight. I think we will, but it's gonna be closer than it should be. All right, take care.